Welcome to another video where we discuss some of the key differences between market profiles and volume profiles. This video takes into consideration that you understand the basics of market profiles and volume profiles, and we will discuss some of the key differences between them and what we look every single morning when we are analyzing the market. So right here we have a market profile. We can see the representation of a bell curve. This is a single day, and we have the 70% of market activity occurring within the value area, which is this blue box right here. The value area high is right here, the value area low, point of control. We can also see where the market opened. Well, the half back is right here, and we also have the ability to see where most of the volume occurred. This is a profile from our Sierra suite where we have adjusted the letters to show also directly on the letters where the high volume activity occurred. You can see the market close right here, the initial balance, which is the A and B periods right here, this blue line right here, and basically market profile reading the market structure. And we can see each letter is called a TPO, it's and every letter, and its period, for example, this M period right here is 30 minutes, okay? Right here we have the volume profile. Every single platform that you've used probably has this. It looks like this. Many people just use the value area right here at 68% instead of 70, but we always use the 70% on the market profile. What we are looking on the volume profile is volume per tick, while on the market profile this is time spent in the market, okay? Combined, you have this visual representation. As you can see here, if you get them next to each other, we can see the low volume nodes right here is where the market spent the least of the time, okay? The volume profile, the main difference, as you can see here, you can see some of the nuances that the market profile is providing. For example, you can tell where the market closed, you can tell where the market opened, where the halfback is, and many more, okay? We can also see here the volume point of control doesn't always have to align with the time point of control, okay? Same with the value areas. So heading into this representation here, we can see some of the key differences that we highlight right here. The main one is time and price for the market profile, and volume and with price, okay? So with market profile we can tell some of the nuances of the market. For example, if the market had a poor low, if it had excess and so on. While in the market profile we can just see where the most volume was traded and the high volume nodes and stuff like that, okay? Market profile combines time to create a graphical representation of market behavior. What we want to look for on the market profiles is structure and basically, where the market is building value and accepting new prices. Volume profile places a paramount emphasis on volume, aiming to assess the distribution of a trading activity at different price level over a designated time frame. For example, the low volume node right here, as you can see, this is called excess, a set of single prints above. Same with the low right here. This is excess. If it was not two single prints or one only, in this case, this is an example on ES, this would have been a poor low. You wouldn't be able to see that on the volume profile. Again, the market profile is time spent in the market via and the price right here, and the volume profile is representing the high volumes and low volumes on each tick. A similarity that both share is the value area. So some traders again like to use 68% because of the normal distribution right here for the volume profile and 70% for the market profiles, okay? Value area is where approximately 70% of trade took place, okay? So if 70% of the trade took place right here, if the market tries to disconnect from this area right here, there are pretty good odds that we will at least revisit this area right here. Very often we say that focusing on value rather than price itself is a very significant nuance that you have to look at. Okay. By distinguishing price and value, value helps sort out some of the prices that were less significant on any particular day. So for example, if the market spent, if there were 40 contracts traded at this level right here, the price was not significant. The buyers and sellers did not agree this as a fair price, and the market simply returned back to build value right here. So if we have a lot of days where a significant amount of traders agreed on, for example, trading this level area right here, the odds are good that we will at least return at some point at this area and conduct two-way trading, meaning you can just buy the lows right here and sell the highs right here. This is not true when we are dealing with a trend day, but this is a different type of window that we will discuss. So the more time is spent at a particular price, the more perceived value has at that level. As you can see here, the point of control is the representation of that. This is again the time spent in the market, and we can see the most time that was spent in the market was right here at this level. This is a time point of control. As we mentioned earlier, the POC of the volume profile doesn't always have to align with the POC of the market profile. As you can see here, the POC was up here while the volume profile was down here in this blue, as you can see. Now, as price disconnects from value, we can find opportunities. This is a very critical type of understanding that we have to realize. So if 70% of the market activity occurred within this box right here, as the price disconnects from it, okay, as the price trades up here, doesn't always have to be a certain period. For example, this C period was very high. When the C period was up here, the value area was around down here, because this is moving as the market develops the profile, okay? For example, this attempt at H period right here, the value area was up here. So as the price disconnects from value, which is right here, where buyers and sellers agreed for two-way trading to trade the significant price right here, the market simply returns and retests this POC, okay? So for example, if down here is good support and it's low volumes as well, then the odds are good that we will look to retest the POC at least, okay? This is again a balanced profile. This is a normal two-way trading. It's not a trend day, okay? And you can see also on the volume profile right here, as the price disconnects, very low volume, okay? Low volume nodes. This was key resistance for the market. The bulls try to push the price higher, the market simply returns back to value, okay? Generally, the more time you spend at a particular level, the more volume is traded at that level. Same deal. What we wanted to see if the market was going to break to the downside was the volume to follow up. Same deal right here. We have 40 contracts traded on a 4-tick profile right here. This is a very non-significant level again, and the market simply returned back to value. Same deal right here. Now let's have a look at some realistic examples that we also share with our followers over on X. And we can see here, this was an example of this particular day right here. We say 3 TPO wide high, okay? Pretty good odds that the market will revisit this high and break above within the session. We can see here how the market was kept shorting this reference right here. This created a very poor high. In the market profile, you can see the 3 TPO wide. Generally speaking, the more TPOs align on a particular level, the higher the odds that we will break above. On the volume profile, you are not able to see any of that, okay? As you can see here, you simply see a low volume node. This is a market nuance that we are looking, and it's market generated information, okay? What happened next? The market broke above, okay, in the overnight session and at the close as well. If we look at the periods right here, if we split the market profile, you can see right here the market attempted again, it returned where value is, and then following up on the overnight session, the market broke above, okay? This thing, the poor highs and poor lows and single prints are things that you can see on the market profile. You're not able to see those things on the volume profile, but there's some similarities. For example, the excess, this is called an excess. Okay, the market opens, goes back down, then returns and follows to the upside. You can see it trades very low volume right here. Okay, but on the volume profile, when you have them next to each other, you can see some trading activity right here. This is where the volume profile comes in hand. Okay, so the market finds some value right here. Okay, guess what? The next day, the market returns towards this high volume cluster that was formed right here and bounces back up. Okay, in this particular day. So this is some of the nuance that you have to look at least we are looking at. And this is again the shape of the profile. This is called a P shape. It's usually an indicator of shorts covering, a short covering trend day in this case. So poor high, excess above. That was another realistic example. Let's look at one of the recent ones. Right here you can see the market builds a lot of volume right here, as you can see this area. This is forms some type of balance right here. Let's remove the overnight sessions and look this in only the US sessions. As you can see here, poor high right here, another poor high right here. We have no excess to finish the action, okay? And guess what happens the next day? Market moves up to clear these references right here. Excess marks the end of one action and the beginning of another action, okay? So the odds of being short in this market on this particular day, following up, you have two instances where shorter time frame traders get shorting the market, but did not find any meaningful continuation. As you can see here, it simply bounced off of the value area highs right here. Then the next day you have excess above. Okay, so this is what market generated information basically looks like. You have no excess, and the expectations for the next day, it's pretty good odds that the market will clear this weak structure right here. Remember, it's simply odds, not absolutes. Okay, so in terms of the volume profile, we are looking at the low volume nodes and mark them as key areas that the market likes to reject off of. Okay, so you can see here this low volume node right here. Actually, as the market opened up here, it returned back to and found rejection and bounced off of. Always mark the low volume nodes on your platform. In this case, we are using the Sierra suite that we built exclusively for trading ES and NQ, and that's some of the key differences. As you can see, again, the POC of the volume profile and the market profile doesn't always have a line. And there's some cases, for example, right here, the point of control of this particular day acted as basically the bottom where the market finished. You can see here it built some value right at this point of reference. And again, the volume point of control in this particular day acts as the bottom. Okay, the market returned back towards it. This is called a naked point of control in this case because it has not been revisited and the market bounced off of. Again, it's different. It's down here and the time point of control is up here. That's some of the key differences that we looking every single morning. That's why we are using the market profile in order to read structure, to see some of the nuances. For example, the pull highs, the type of day that it is, if it's short covering or liquidations. Do we have pull highs? Do we have good excess above? For example, this is good excess, a lot of single prints. Okay, where value is shifting, if the value moving towards the upside, the downside, where we are building value. Because again, when you disconnect from the value, for example, if the market perceives this area right here as very key value area, you can see when the market opens here, it returns back towards this high volume area. This acts as magnet of price. That's the scope of the high volume nodes, while the low volume nodes reject price. As you can see here, this low right here was exactly on a low volume node. Okay, same deal. This is called a spike, and the bottom of the spike acts as support. If you drag a box right here, you can see the spike right here, the bottom of the spike. The market opens, breaks above, every test right here on this period was the absolute bottom. Okay, again, in this particular day, it's one data point. You can't just wake up and see this is a poor high and you expect the market to simply go higher. Guess what? The next day, the market returned lower. It traded lower, okay? You can't just trade off of one data point. This is why we are using our toolkit with a combination of confluences in order to understand market structure and trade safely. So if you want access to this exact Sierra suite that you are using every single day in order to perform market analysis using order flow and market profiling, be sure to check our website. We have advanced footprints, advanced market profiling, and of course a 70-page ebook course that you can take that explains an introduction of market profiles, order flow, and market auction. We also have a set of bonus items for one price fee. Thanks for watching.